Good morning and welcome to the update on the Strategic Metals Fund. I'm Colin Thompson from the sales team at Amati, and updating you today we have the funds manager, George Lakeem and Mark Smith. We're also very pleased to be joined by Jamie Strauss, the CEO of Digby, who will present on ESG factors specific to the metals and mining industry. While many investors view mining as a dirty industry, the paradox is that to reach commitments made by governments in relation to reaching a lower carbon world, certain metals are critical in this transition. There are more or less environmentally friendly ways of extracting those critical metals, and we look to invest in the cleanest projects with the best practices. After the presentation, we hope to have a discussion based around the questions from the audience. So please submit your questions via the webinar page and we'll address them at the end. With that, I shall hand over to Mark.
Thank you, Colin, and good morning, everyone, and thank you for attending another Amati Strategic Metals Fund Brighttalk seminar. Today we've decided to briefly present the key points of the fund, but more importantly present a topic which I think connects mining and decarbonisation, and that's ESG. Jamie Strauss, the founder of Digby, will present the merits of his firm and hopefully start the conversation, which in some respects is a green paradox in my view. We need a change in the investor's understanding of mining for this sector to get fully capitalized to meet the very onerous supply requirements needed for decarbonisation. The Amati Strategic Metals Fund was launched 2 years ago with an evergreen fund approach, and we were specifically targeting investment opportunities in the battery, critical metal and precious metals sector. The managers of the fund have an industry and financial experience, and this allows us to invest in resource development risk. And this is key here. This is where we specialize in investment opportunities. And we're specifically targeting the small and mid-cap companies. The average portfolio weighting in the fund is about $1.5 billion. I think if you believe in the future metal demand from global decarbonisation, then you want to invest in these companies. A prime reason the fund was launched in the UK was the absence of an actively managed fund driven by bottom-up value analysis, where the investor can gain exposure to rising metal prices, M&A, and exploration discovery, or as we call it, value through the drill bit in one fund, with, I may add, low management fees. And I think we've achieved in the last 2 years providing this fund for this exact purpose. The metal inequality between future demand and mine supply is well understood, and I'm not going to talk about that today. For those topics, the managers have waxed lyrical on our fact sheets, newsletters, presentations, the site visit series that we've rolled out, and the podcast. And all these can be found on our website, which is amatiglobal.com. Or if you want to contact our sales team for further information, all the contact details will be at the end of this presentation. I'm confident in the natural resource metals industry will become a mainstream investment avenue, given the magnitude of finance needed to increase metal supply onto the market to meet decarbonisation demand. As such, I think the conversation should be, how does the world decarbonise without mining? And the answer to me is pretty simple. It can't. Mining and ESG are integral. But the mining industry has been practicing ESG for many decades prior to the term becoming a greenwashing exercise, I think, used by many other industries. Since launching the fund, we've experienced very volatile markets. We've had fiscal instability, fragmented supply chains from COVID, strong inflation really driven by monetary debasement rather than solely consumer-led demand inflation. We've had rising geopolitical risk and the emergence of the petro one. More recently, we've had the second largest banking collapse in US history with SVB, And this has all been wrapped up with the euphoria of electric vehicles and Elon Musk's desire to take on the world. I think these are somewhat flippant comments from me, but it serves a point. There are two strong bookends to this fund: critical metals and precious metals. And investing in these sectors has served us very well in navigating these risky, volatile markets. With the fund's ability, with our evergreen approach, to adapt to perceived value in the market when it presents itself. If you look at this chart here, we've basically indexed the performance of our fund in green to the VanEck Junior Gold ETFs. That's a gold proxy, indices in the gold, and the S&P TSX, which is the base metal. And you can see that we've been able to match the performance of the base metal only funds and materially outperform the gold index. And this has been done through having a concentrated portfolio in the fund and also through our stock picking. Since launch of the fund, we've had over 6 companies taken out, and a lot of the stocks we currently hold have specific value drivers where we deliberately invested in these companies because we expect more resultant M&A to continue over the next years. These, again, are our 3 legs to the fund. We've got development. We're investing in development risk. We're investing in recapitalization of mines. We're investing in exploration. And then over the top of that is all M&A, which you get a premium on top of your investment. And I think George will talk more about these 3 legs to the stool in the next few slides. I think key to investing in the resource space is not just technical understanding of the mining companies, but also managing portfolio risk. And we do this by applying many filters. First, we have a metal type or an asset split, market cap weighting of the investments we hold in the fund. We have a geographical exposure, and this dovetails into our HESG guidance and principles of investing. And then also we limit the number of investments and the type of investment we hold in the fund through exploration, development, production assets, or royalty companies. Now I'll hand over to George to discuss the attributes of the portfolio and its structure.
Thank you, Mark, and good morning to everyone from my side. The 2 strong bookends to the fund are clearly illustrated by this slide, with 35.3% of the fund's investments exposed to the battery metals, lithium, graphite, manganese, and rare earth metals, and 46% to precious metals. This is as of the 31st of March 2023. One could easily argue that silver sort of straddles between being a monetary asset and an important green energy and EV metal going forward. So the balance is probably 50-50 between precious metals and battery metals. We also invested in 2 uranium companies since our last call, given the energy dependency initiatives that are currently taking place, especially in the US. Nuclear energy is currently responsible for around 20% of the US's needs and about 10% of the global needs. As Mark mentioned from the onset, the fund's preference is to invest in development companies where we see the greatest upside through the unwinding of development risk. They also tend to have a greater exploration upside relative to their market cap. This is always where you get the best returns as an investor in the mining sector, especially when we're going through the recapitalization and exploration phase, which is where we see the industry over the next 5 to 10 years. We tend to shy away from the small and pure exploration companies, and we prefer near-term producers and medium-cap established producers. 42% of the fund is invested in companies with a market cap below 500 million, and another 34 is between 500 and 2 billion. We also have 18% invested in companies with a market cap above 2 billion. The fund is set up to give investors a globalized exposure to mining companies. And there are many areas where we're restricted from investing, such as the FSU, China, parts of Africa and South America. And we tend to prefer lower risk quality assets in reasonably stable jurisdictions. Naturally, we have a high exposure to North and South America with 61.2%. Australia is our next highest exposure with around 15%, and then Africa with 11.55%. Now, as of the end of March, you can see the AUM was around 94 million sterling. This is closer to about 100 million today. Mark mentioned earlier about the market cap distribution, with the average market cap of the funds holding 1.5 billion. We have a stated aim to hold between 40 and 45 companies in the portfolio, given the work required to constantly monitor the companies. And at the end of March, we had 46 companies, but 2 were in the process of being sold, one given a takeover bid and the other had reached the target price. So you can see our definite preference for developers where we believe the best value is to be had, especially over the medium to longer term. This is just a snapshot of the top 10 positions in the portfolio as of the end of March. Sigma Lithium has been a great investment for the fund, and the company has just declared first production of spodumene concentrate at its project in Brazil, on time and on budget, which is very rare in the mining sector. This is a classic investment for the fund, where we rode the unwinding of the development risk discount. The stock is currently near its all-time high, despite a significant pullback in lithium prices over the past 3 to 6 months. Had you invested in the beta plays like Albemarle or SQM, both very good companies, you would have been down 20 or 30% on your investment over the past 6 months. Actually, last night, one of the brokers in Canada just upgraded the target price of Sigma Lithium by 25%. So half the top 10 are specialty metals companies. All are developers apart from Trident Royalties. Sabina Gold was subject to a takeover bid of 46% takeover bid, and it snuck into our top 10 holding. So just to give you a bit of a synopsis on the outlook, in our opinion, we still face a very uncertain future in 2023, and we believe that it's still prudent to remain cautious about global growth expectations. At the moment, the market is very optimistic about a strong economic rebound in China and a moderate growth in the West. And that's been fed through by very long positions in most funds, which is in copper, for example, which in our opinion, is a bit of a crowded trade at the moment. Supply disruptions are helping to keep the copper price above $4 a pound, which is sort of feeding the short-term narratives. And when we look at the valuations of the companies, they tend to be a bit stretched. So we believe that the best positioning right now still remains to be in the green metals. The EV and renewable energy metals will hold up the best over the short to medium term, in our opinion, especially in a prolonged inflationary environment or stagflation environment, or even in a recession environment. It's been tough for investors in the lithium and graphite space over the past 6 months, with lithium prices pulling back from the sharp rally that we saw in early 2022. This pullback to normalized levels was very much expected, but it took all the momentum out of the lithium stocks. Now that we're seeing the lithium prices stabilizing, we're starting to see a bounce back in recent days of some of the stocks that were clearly oversold. And the lithium market is still a very immature investment sector, and hence we still see quite a bit of volatility in the sector. The pullback in the stocks has actually revived M&A in the sector, and we expect this to accelerate in the coming months. Now, we don't have any strong views on the direction of gold and silver. Safe to say that the headwinds that we faced in the gold price in 2022 are certainly fading, with the dollar strength abating and the aggressive rate hikes seemingly coming to an end. In our opinion, the equities are still very much out of favor and have not really moved up with the gold and silver price move. Hence, we are encouraged from a risk reward point of view still to have about 45-46% exposure to gold and silver companies. Typically, the large caps move first, followed by mid caps and developers, and then the silver companies. This encourages us that we're going to see a catch-up trade for the developers and silver companies, given the very strong performance by the tier one gold companies in recent weeks. The earnings season is also about to start, and we'd expect earnings and cash flow to be revised upwards across the precious metal sector, given where prices are today, especially that the mining companies have been reporting significantly lower inflationary pressures. So as far as investment opportunities are concerned, we continue to actively look at opportunities and have actually, in fact, added new investments to the fund in recent weeks. As Mark mentioned from the start, ESG is a very important consideration for the industry and for the fund going forward, especially as a risk management tool. And we felt strongly that we should start sharing this with you. And following me now will be Jamie Strauss, the founder of Digby, who we have partnered with to add another layer to our ESG analysis of the companies that the fund invests in. So now I'll hand over to Jamie to take you through Digby's initiatives. Thanks, Jamie.
Thanks, George and Mark. And I'd like to just start off, first of all, good morning to everybody, but also to say how excited I am to be working with Amati and particularly with the Strategic Metals Fund. For what we're trying to achieve through the Digby ESG process is to enhance the credibility of the mining industry, and also to some extent to re-educate or to allow people to be re-educated with the benefits of mining and the benefits that mining provides to society, both through communities, the impact that it has with regards to environment, to protect environment and biodiversity. And if we do not collaborate with the different groups, then clearly this it can't be done with a single person or a single group. So to collaborate with fund managers, such as the Amati Fund, to other private equity, traditional fund managers. Digby was originally initiated by BlackRock and Orion, Orion being the largest private equity group in the mining space. But further than that, working with sell-side brokers, supporting the debt houses, the insurance sector. I was with the insurance industry yesterday, trying to give them the ability to access quality data into the mining space to incorporate within their products, and ultimately to work through blockchain to further communicate this and to allow for green premiums to ultimately evolve. And going back to some of Mark's comments. So this slide really just relates to we are moving to a sustainable economy, and I think we need to re-educate even to my children of 5 and 6 years old that if it's not grown, it's mined. And it's really simple, and we've got to make sure that we do so in a better way and that we can demonstrate that the mining industry is doing so, is expanding its production to meet the 1.5 degree scenario in a sustainable fashion. And as Mark and George just highlighted, the growth in metals over the next 20 to 30 years in order to meet that 1.5 degree scenario is substantial. What is exciting is that the industry gets the fact that in order to do that, and in order to get or to have and receive a social license to operate, it must do so in a sustainable fashion. The problem is that the mining industry is still considered on the left-hand side of this slide pre-1995. Its perception is that rape and pillage of the world's earth, water pollution, environmental hazards are commonplace, and limited governance. Now, nobody is saying that the mining industry is perfect. There has been bumps along the way, but if you look at the statistics across virtually all of this, with improvements in corporate governance, in dramatic improvements in health and safety, with environmental protections covering every single part of that sphere, as well as social engagement and reduction in conflict, the sector is in a very, very, very different place to where it was 25, 30 years ago. But the failure to communicate that effectively has resulted in the sector still being the highest cost of capital across virtually all industries, and at the same time having a valuation which is fairly dismal. I think 5.5 times for the leading peer companies. The opportunity to take that data, to take those statistics, to communicate more effectively is very, very real. And it's very rare that one gets an opportunity from an investment opportunity right at the beginning of a cycle where you've got all of that data clearly available, but you're now, through a mechanism of ESG, being able to transform or to communicate that information in a realistic and trusted and capable way. The ESG orientated funds under management are going to double in the next 3 years, as per PwC. They increased by 25% last year. The mining industry touches none of it. And there is the huge opportunity with which we can effectively look forward to. If we can begin to prove and demonstrate the sustainable operations and development that that's taking place within the mining industry, and we can begin to remove reputational risk within the fund managers of ESG orientated funds, we can begin to see streams or new flows of capital from these areas. Now, the future of mining industry is therefore increasingly being shaped by ESG imperatives. There is no social license to operate unless we incorporate that. What is exciting, as I repeat, is that the mining industry already acknowledges that, and it has already taken shape to do that. Now, there will be winners and losers within this game, and that's where we need strong stock pickers to identify the companies that are embracing it in order to ultimately get that lower cost of capital, access new pools of funds, and also raise valuations. But there are many other benefits that goes with this. Reduced engagement, or reduced, I should say, conflict with local communities, an improved social license to operate, and there's a whole bunch of other things that go with that. Now, BHP, which many of you will already be aware of, has led the way. They paid a 50% premium, well above normal, to purchase Oz Minerals, which got concluded earlier this week. Oz Minerals was a copper story. It was in Australia. It had very strong ESG credentials, and it provided it dominated in the metals of the future. The CEO of that company highlighted the importance of traceability of those commodities, but also therefore the end result of pricing differentials that are going to materialize from that. It's those sort of nuances that are going to involve improved valuations and differentiation between the different companies in the mining space. Kabanga is a new company that's coming onto the New York Stock Exchange in the next few months. It's a nickel project in Tanzania. It has recently completed a roadshow in New York, and the CEO was very public in saying there's been very little money raised for the green metals, and that they were able to access a lot of that money, which is now clearly focused. And Sigma, funny enough, was one of the other companies mentioned on that, where they have very strong ESG credentials in place. What's interesting is that Kabanga has received $100 million from BHP and have very, very clear focus and intention on their strategic ESG credentials. The losers will find it increasingly difficult to obtain financing. The cost of capital will likely increase, the valuations will remain subdued, and the social license to operate will be tricky. This is a well-known story where Rio Tinto unfortunately blew up the Juukan Gorges in Australia, a cultural heritage site, 3 years ago. What was interesting is that it took some time before the differential between BHP and Rio Tinto really took shape. I think the whole sector was rocked by this initially. But what was good, and this is not just a negative, it's also a positive, is the negative was there was a huge value differential that materialized, over $22 billion worth of lost value to the Rio Tinto shareholders over that period of time. But the positive, which is I think really almost more important to focus on, is new management, new board of directors, a renewed interest in culture allowed that differential to change relatively quickly in the course of the last 12 months, really showing the impact of positive ESG when you begin to get on top of that and addressing the underlying issues. There's the differential beginning to show up with regards to the ESG, or the green premium as one could call it. Now, the common thread here is ESG or sustainability. There are areas which the sector continues to be weak on, GHG emissions as an example. But because you can measure, manage and communicate now, it is easier for the company to get on top of this and begin to go forward. The sector, however, is really important to understand that the sector has been doing this for 25 years. There are areas on this slide chart which are standard practice for the mining industry. Clean water for local communities, reduced volume of water being used, so closed circuit water capability, improved housing, education, healthcare within local communities and within their employees, as well as procurement. One of my favorite ones is local procurement around mine sites, where you can create a new business which is not 100% linked to just that mine. It can continue after that mine has closed, as well as through rehabilitation. So there's some real positives here to bring communities on side, raise living standards for local people and protect biodiversity and improve harm. So what do mining companies now expect? And the importance of having a relationship with Amati from our point of view is that the stewards of ESG are the financial groups. But if they're just given 200 pages of fine text in order to go through on every single company, which is in an unstandardized way, it's going to be very difficult for these people to be able to apply ESG in an effective way. So what they really require is credible ratings through a standardized approach, both on the input as well as on the output, so that companies know what to disclose and to ensure that there is ongoing value to that management and board team, so that they can continue to aspire to a positive impact going forward and can be held accountable to that. Equally, if we can achieve that, we can then begin to differentiate between the companies, between the good and the bad, and therefore the green premiums will evolve. And if we can do that, we can begin to communicate these ESG efforts, not just to the financial community, but equally to society and other stakeholders, and improve perception in the world generally. The problem, as I was just alluding to, is the sector doesn't do itself any favors. Most companies sadly put out a single slide with a very nice green tinge to it saying ESG. There's no standardization, it's self-serving, it's promotional, it doesn't cover all the ESG topics in the spectrum, and there's no peer comparisons or methodology followed. The frustrating thing is that the data is there and available, but they don't know what to disclose. So that's where Digby effectively has come in to measure, manage, and communicate. Provide these companies with the ability to have aligned to global standards. The global standards are critical so that everybody can effectively move in the same direction. We've effectively mapped to these global standards and ensured that our frameworks are aligned to them. To ensure that we have internal reports which are available for that management and the board, to give them the opportunity to have a right to respond, to raise the quality of these reports, so that the board can effectively discharge their obligations on ESG, but equally allow management to communicate internally and to provide a gap analysis and a roadmap going forward. To ensure that this is publicly available to relevant stakeholders, so that everybody can access this information, which can therefore improve transparency, reduce conflict, and improve confidence and trust, which ultimately can have an impact on valuations and cost of capital. To ensure that these companies can be tracked over time and can be compared on a context-driven basis to their peers. And ultimately, for all companies to have the ability to communicate, not just to George and Mark, but equally to the local communities, to their insurers, or whoever it happens to be, again, to make sure that we can effectively manage, measure, manage, and communicate. And to ensure that that is simple, it is easy to read, it's accessible and standardized. Lastly, we do incorporate an ESG certification capability, which is increasingly going to be available for blockchain. Blockchain is important because it is the means to an end to create green premiums. And if we can effectively give an ESG accreditation to a company that they have completed an independent assessment and ensure that that data is freely available behind that, then people can again gain trust and confidence within that process. Lastly, and it comes back to conversations I think we were just having, is this needs to be driven by the financial industry. If the financial industry are the stewards of ESG and they can encourage the adoption of ESG throughout the mining frameworks, we can have this ability of turning the worst perceived sector on the planet into a sector which is accepted as part of society, can encourage new pools of capital to invest, reduce the reputational risk that has been around for so long, and show that the sector is rightfully part of society. So on that basis, I thank you all very much indeed. And again, thank you, Amati, for the opportunity to present today to you all. Colin, I think you're on mute.
Made it. Thanks, Jamie. We have a few questions now, so I'll put the first one to everybody, if you'd like to have a bit of an input into it. As things stand, the drivers for metals prices on supply-demand imbalances are obviously very strong. Is there any medium-term risk, in your opinion, of a reversal in this dynamic, should Western governments realise they simply cannot follow through on their policy promises, net zero, petrol car bans, gas boiler bans, etc., due to a lack of feasibility, or will they plough on regardless?
I'll start, Colin. I think it's an important point because you see a lot of presentations that give the most positive demand scenario out there for metal, and if the whole of the planet's going to decarbonize in the way that they need to meet net zero, the numbers are just astronomical in terms of demand. So the point here is that's a top case scenario. It looks very good. The lithium would need to increase 21-fold, nickel industry 6-fold, the graphite industry 10-fold. That's not going to happen. So reality is, I think the expectations of a decarbonized scenario is probably somewhere in between what the government's pledged at COP26, 27. But that's needed because the demand is too great to meet that. So I think there's going to be some middle ground here. What that means is metal prices will be higher for longer, but what that transpires to is technology will look to thrift out critical metals in these applications. They'll use less of it and they'll use it more efficiently, which will reduce the unit price of a battery in an EV, the turbine in a wind turbine. And what that will mean is that you'll get a greater distribution of these renewable technologies globally, but they'll have a smaller metal input. So I think that's something to consider. We're not going to see the net zero by 2050, in my view, if the metal markets don't suddenly put $10 trillion worth into the ground to extract metal. The metal's there, but the financial community is not there yet. And as the question pointed out, we need a lot more political will to streamline mining companies and reduce the permitting timelines from 10 years to maybe 5 or 6 years.
Does anybody else have an input on that one, or shall we move on to the next one? Next question. You mentioned potential new pools of capital. Have you seen any evidence of this entering the mining industry?
Oh, it's a great question, and very topical. So there's well, first of all, what I should say, which is quite publicly available, is the OEMs, the car manufacturers are now very active. You've seen deals done by Volkswagen, by Tesla, and by GM, as well as one other, I forget the name of it, with McEwen Copper down in Argentina, all now involved with trying to ensure that they secure appropriate quantities, but also from appropriate countries, their raw materials for the future. So that and all of that is driven with a sustainable lens. So that's very publicly available. So yes, that's I'm very surprised that those announcements have not led to a reversal in the current equity markets. I think that's been a bit odd. perhaps compounded by wider events geopolitically or whatever. Having said that, it's the other areas which really could begin to support on a much longer term basis. And I do see that those OEMs furthering that engagement. You have seen the US Reduction Act, Inflation Reduction Act, having a big impact in this as well. But it is the ESG orientated funds I was relating to earlier that I think has this bigger, longer term trend that can happen. At the moment, they have decided not to invest, and this goes back some years or even decades. What is beginning to materialize is that they're all beginning to circle and see this sector as critical for the future of the transition to a sustainable future, where mining companies actually have been doing this for quite a long time and is a leader in many areas of ESG, and can show impact on the ground in the social element, as well as to some extent within the environmental impact, where there can be positive impact. I was aware back in December of a French bank talking to a number of European investors who are looking to invest in the sector. I know that's ongoing. I was talking only yesterday to the largest impact fund in Europe, who is actively looking at the mining sector and looking at ways that they can reduce their reputational risk of the word mining, show that there is positive impact, and effectively, I guess, look to enter the sector in some way or another. Now, I don't think this is going to happen overnight, but I do see this as a very, very significant impact on potential valuations over the medium to longer term from a sector that has never invested in the mining industry.
Thanks,
Yeah, I
Jamie.
just want to just to add to what Jamie is saying is that we're not seeing it from a valuation point of view, a differential yet. As Jamie mentioned, it's a slow burner. It's generalists are starting to take a lot of meetings in the mining side, and I speak to other colleagues who run specialist mining funds, not getting the investment dollars being put to work. Probably, as Jamie mentioned, geopolitical events are holding him back to some extent. But the curiosity is there, and it's keeping the sector in the attention sphere of investors, and I think it's going to be over the next 3-4 years that through initiatives like Digby, through greater education, what's going on actually on the mining side, that we should start getting that valuation differential closing between the mining sector and the other sectors in the market.
Great stuff. Thank you, George. We've got a couple of questions that are very, very similar, both asking for examples. So I'll read them out. Are there any examples of where poor ESG from a company has led to the managers not investing, even if the quantitative analysis is positive? And can you give an example of where ESG has worked out in your favor? So similar questions. Who would like to take that one?
I can talk more generally, and then perhaps George or Mark might even be able to talk on a specific issue within the fund. And I chaired a panel back in September last year with a number of the royalty companies, and this exact question came up then, and it was a really interesting debate that went on. There will definitely be examples in the modern world where investment has not happened as a result of ESG factors. And there are a number of companies which perhaps are dumping tailings into the ocean, which clearly is a non-starter for most investment managers these days. They don't tend to come out in the public that a decision has not been taken, but there's no doubt that is now an influence with the decision-making process, particularly with public financial brands who are respecting their own reputational. Where I think it's perhaps more relevant, though, is what is the process of going through this, and how do areas of remediation or opportunity get addressed? And this is really where it came out in that panel. It is, if you can do an ESG report, whether it's through Digby or ultimately through a long-winded due diligence process, which anybody may do, is that you tend to come out with orange flags, maybe green flags, and maybe red flags. The red flags are very rare. The mining sector generally does ESG, and therefore the red flags are very rare. The orange flags are areas of opportunity. And that's why the investment community is so important here. They can engage with that company and they can encourage that company to say, we need to address X, Y, and Z over a period of time in order to get a better result. And that's where the active participation of the financial community and insurers can have this positive impact on the ground to ultimately de-risk that project and ultimately end up with a better result, which hopefully was reduced conflict with local communities, possibly positive nature or whatever else it happens to be. So that I think is really exciting and is very much a more practical approach to examples where poor ESG is effectively leading to positive output.
Yeah, Carl, and in terms of some examples, I'm going to be quite broad because I don't want to name and shame publicly, but there was an Australasian gold development company that we were looking at, and previous management had nickel and dime the social side of ESG in terms of the housing that they were going to put on site, and it was very inferior, and it led to the community rejecting the replacement housing that was on offer. And ultimately that led to the social license being revoked for that asset. We saw this coming. What happened was they lost their license, new management came in, they reappraised the social side of the application, got the license back, and then they tripled the sunk cost in these housing units that were initially put on site to try and win back the community. But we saw it from first instance that they was going to face a problem, so we didn't invest in that company. An example where the company was a great ambassador for mining. We've known the company for 20 plus years and all management and have been on site. It's a company in Africa that's a gold producer that were looked to get an asset in Sudan. And for us, when we applied our HESG, so that's our Freedom House principles of investing, Sudan scored very low in political freedom. And as such, we couldn't invest in that country, regardless of the quality of the company. And I say on the ESG side of things, this company did exceedingly well in terms of what they had provided on the existing mines in other countries in Africa. But because they went into this country, we saw it as a significant departure from their strategy. And then we had to sell our investment in this gold company, which still had a lot of upside. Hindsight is very powerful, and you can see what's happening in northern Sudan now. You sell on sentiment, and this company has been sold off because of the political issues in Sudan. So that's an example where our top-down screening on ESG through Freedom House principles work very well for us. So what we're trying to do is avoid problems before they occur, and there are plenty of countries in the world that we can invest in that don't have such political risk.
Colin, I'll just add one thing to Mark's comments there. So the decision where to invest is an investment management decision based on risk analysis, which is what Mark has effectively just gone through. Where the Digby process effectively works for the whole mining industry is that we contextualize every project. And context is not just, and therefore to try and come up with a value for that context. And that context is not just geographical, it's what are you producing? Simply put, is it lithium or thermal coal? That's an important differentiator, as an example. But what are you producing? How are you producing it? Where are you producing it? Are you in a UNESCO heritage site? What's upstream? What's downstream? Are you in a biosphere, glacier, river, etc., etc.? And so context is really important so that you don't pigeonhole or you don't bucket people like the DRC has a high risk. That doesn't mean to say every single operation in the DRC is poor. It has a higher context risk. What we're trying to identify through our process is to make sure that the management teams who are there, who are adhering to best practice, can then come out and rise to the top. That will then give the ability for investment to go forward and to move that forward, even though there may be other parameters which fund managers may use from a decision-making process as to whether or not to include geographical area or not.
Great stuff. We have one final question, and it's for Jamie. Is the Digby ESG data solely for the privilege of fund managers, or can it be accessed by others?
Transparency is critical, Colin, and this is why it's available for everybody. You know, we want to get local communities welcoming good operators into their community, but also to hold them to account in order to not only improve lives, but make sure that they operate safely and go on a going forward basis. So it's very much available to everybody. I would just add, because the mining companies will no doubt be listening to this as well, every company gets the right to hide their scores for the first 12 months. There's no prizes for putting out a single baseline score. What we want to see is monitoring of or demonstration of ongoing improvement. And therefore, that second score and subsequent years is really the key focus here. A single score is irrelevant. No, I don't think any fund manager looks at a score. They're looking for, from my discussions with the whole industry, including insurance, is we want to see companies embracing ESG and doing something about it. And what we want to then do is to communicate to all stakeholders that continual improvement. And if we can do that, again, it comes back to improving confidence and trust.
Fantastic. Thanks very much, Jamie. So thanks for your presentation and for answering the questions, and thanks to Mark and George for their presentation, and to you, the audience, for actually putting your questions forward and for your interest in the fund. If any further points come up in your mind, please get in touch with one of the sales team, visible on the slide there. And thanks again for joining us. And until the next time, goodbye for now.